Hello, everyone. My name is Gary London. I am Senior Principal of London Moeder Advisors here in San Diego, California. And I've got with me my colleagues today, Nathan Moeder, who's Principal at London Moeder. He's the motor part. And I have Norm Miller, who has been affiliated with us as a friend and consultant with us for some time. And Norm is I guess, he says he's retired, but he's not really retired, accepting from full-time professorship at USD, but he's doing a lot of things in the economic and real estate world. So I thought we'd get together just to have our occasional discussion on what the state of the market is from both a sort of global, national, and ultimately local real estate perspective. And I think the catalyst to this discussion is the fact that we're seeing at least takeout rates already dropping in the real estate arena. And we've got the prospect of the Fed's meeting, I guess, next month to discuss a rate reduction in light of the economic factors softening to the extent where they feel that the time is ripe to do that. And so I want to sort of talk about that all in the context of what I think we all agree has been effectively a real estate recession over the last couple of years with respect to at least housing and the commercial markets, which putting industrial aside, which has been pretty strong, the rest of the market has been pretty weak. And the question becomes, will that change in light of what the coming situation is? And I guess the overarching question is, are we going to have a soft or a hard landing, Norm?
Oh, I'm in the soft camp. In fact, I'm not even sure we're going to have a recession in 2025. It's possible that we will postpone it because consumers keep consuming, and that's 70% of our GDP. Auto sales are doing well. We're still creating jobs, not as strongly, but it's still positive.
Isn't that sort of the conclusion that the Feds were hoping for, that none of us would believe that they would achieve? That the market softens to the point with respect to all the big economic indicators, but doesn't get to the breaking point where we actually are afraid of recession. We had the scare a couple of weeks ago when the stock market dropped, but things have come back to normal again, have stabilized, and we really have the prospect of the Fed's meeting soon and lowering interest rates because they got the numbers they want, right, Nate?
Yeah, I think quite honestly, if I was the Fed, I'd feel like my hands are tied. They have no choice. There's so much expectation that they have to lower the rates now. If they don't, then I think we risk a harder landing because if they send the message that we're going to stick with it for a couple more months, I think that's when you see consumers pull back, businesses pull back even more. Then there's kind of fear where we can talk ourselves into a recession. So unfortunately for the Fed, there's so much rhetoric and so much enthusiasm and celebration and expectation that in September they're going to lower the rate that I think it's going to be hard for them not to. And they almost have to do some kind of motion and bring it down a little bit.
Has the market already sort of brought the rates down in expectation, or do we think we're going to see lower rates? I'm specifically speaking to the real estate mortgage takeout rates right now.
Well, in terms of your question, the CPI is coming down, and some of it is predictable. The rent decreases that are lagged into the CPI, we know will bring it down further. And so, the inflation fighting game is pretty much over. It's a matter of maintenance. I think I agree fully with Nate that it's not a matter of whether in September rates will come down a little bit, or it's really a matter of how much they'll come down. They have to come down 25 basis points minimum.
You think they're going to go 50?
I'm hoping they'll go 50. They should, but I don't know if they will because, again, consumers are still spending, retail levels pretty high. They're trying to do everything they can to slow things down. It is a bit of a miracle landing.
It is, isn't it?
Yeah, and some people are going to credit the Fed for this. And I think that if it was 1950 or 60, it would be to their credit. But I think the economy is different today.
In what respect?
Well, in the 50s and 60s, half of our jobs were manufacturing. And we had this mentality, protectionism, tariffs mattered. We're trying to protect all those jobs. Today, manufacturing's 10% of our economy, just 10% of our employment, I should say. And so this notion of tariffs really only benefits a very small number of people, but hurts a large number of people. And in terms of the economy, we have this dumbbell kind of economy where one section's doing incredible, this AI productivity buzz that everybody's investing in. And on the other hand, we have housing over here and everything that supports housing, brokers, appraisers, mortgage lenders, title companies, and they're all in recession. But on average, we're still going positive. So we've never really had an economy where it was so segmented, where some sectors could do so well, while others were not doing that well. And the question is whether people can transition fast enough into the jobs that are being created by the AI kind of revolution.
I don't think this is a credit the Fed scenario. I think you give the Fed credit for helping manage it, but I think there was too many forces here that were enabling a soft landing. For one, a lot of the inflation and the reaction by the Fed is just the supply pipeline and the availability to get parts after COVID, and that just really drove inflation. So I think the Fed raising rates kind of slowed stuff down a little bit, but once inventories caught up, business got back to normal, prices started to stabilize a little bit. They don't go down, they just stop inflating as much. So the Fed helped control that, but I think that there's more forces there that needed to be addressed. In terms of the rates coming down and the decrease, the markets are already pricing it in. 30-year mortgages are down to 6.49, 6.5. You look at the Treasury today, it's at 3.8. When the Fed started to nod a couple of weeks ago that they're going to possibly bring it down because of the jobs reports and whatnot, the Treasury's dropped to 3.7 and down to 3.68 or something. And then it shot back up to 3.9. Now it's back to 3.8. So I think the markets are pricing this expectation in, and we're starting to see some movements finally on financing rates.
So if the discount rate goes down big, 50 basis points, how will that impact those numbers, do you think?
I agree fully with everything Nate said about supply chain. In terms of the mortgage rates, keep in mind that the spread is higher than historically we've seen. So the spread over the 10-year Treasury is larger. So even though the Treasuries have come down, the question is, why haven't the mortgage rates come down even more? One of the answers might be the fact that the Treasury has a huge balance sheet filled with residential mortgage-backed securities that they're trying to unload. And if they unload those too quickly, it keeps that spread higher. If they would just hold it or go back to buying residential mortgage-backed securities again, that spread should come way down. But they're not buying, they're selling. And so I think that's keeping the spread up more than otherwise. Otherwise, we should be at 5.5 right now, not 6.5.
Right. The spread right now is like another 2.5 or 2.75% on top of the treasuries. And typically, historically, it's about 1.6 or 1.8. That's the historical norm. So we're almost double the spread of what we typically are for all the reasons that Norm said. The other thing I think is that banks, they've got a choice of how to invest their deposits. Right now, short-term securities are the way to go because you get a great rate on it. And I think we're starting to see the spread come down slightly the last couple of weeks. And if that's the case, it means money's being shifted from short-term bonds over to longer-term ones with the expectation that things are normalizing and rates will come down in the short term. So that means we have to look for long-term investments. And so we'll start to see the spread compress, hopefully.
How do you guys think the election season, I guess it's sort of a two-part question. Part of it is the uncertainty is associated with the election season that we're in right now, which obviously bleeds into November. How does that impact this discussion and the economy in general? And then the next question I'll ask is, what if Trump's elected? What if Harris is elected? What would those two different scenarios, how would they play out, do you think, economically in terms of the nation, particularly with respect to our sector? Want to tackle those first, Norm?
Oh, I thought Nate was going to jump in there first.
Oh, I'll do it.
Okay, go for it. Go for it.
So my thought with that is every time there's an election, I'm thinking about the stock market. It gets nervous, it gets jittery, it starts to decrease. And once the election happens, no matter who's president, because there's now certainty and a path forward, the stock market goes back up and people feel good. We all know that whatever president you pick has to go to the middle on a lot of the issues. And if you look at Trump, Trump may have the argument that he's better for business. So if he gets in, people will rejoice, and the stock market may, because he's technically better for business in some people's minds. But on the other end, there's Kamala Harris, and she may be better as a signal of safe haven for the global economy that U.S. has it under control. So I think either way, whichever president is elected, I don't think we're going to see the market decrease. I think we're going to see positivity because now we have a certain path forward. If we just think about how much uncertainty we've seen in the presidency just in the last couple of years, I mean, I think we all feel like we don't have a path forward yet. So I think everybody's waiting to see, and by everybody, I mean the entire globe, to see what happens in November so then we can start advancing ourselves globally.
Well, I thought you were going to say over the past month, not over the past year.
Well, I think it goes longer than the past month. I mean, the past month has been crazy, but I mean, you could go back the past 2 years. We were talking about Trump versus Biden. What does it look like? I mean, it's just this infighting, and there's been uncertainty for quite a long time. So I think once we get a new path forward, if it's Trump, people will think, thank God it's only 4 more years. If it's Kamala Harris, they'll say, thank God it's not Trump. Not everybody will be happy, but at least we have a path forward, and I think we'll see some positivity there.
Okay, now your take, Norm.
If Trump is elected, and I don't know what the odds are right now, the one really negative for consumers is this idea of putting tariffs on everything. It's very, very inflationary. And that's a big negative. On the other hand, keeping corporate tax rates lower is a big positive, and positive for the stock market. So net, Trump's probably a positive for the stock market, probably a negative for inflation. Now, keep in mind there's a lag. So his third and fourth years when inflation would start to hit. The first and second year it would be modest and people would still be happy. And so it's a slightly positive outlook for the stock market, slightly negative longer term for Trump. If Harris is elected, I don't think she's going to be able to pass a lot of her social oriented proposals. I think they'll be stuck. And
So
so
you're anticipating that there won't be a big shift in Congress?
I'm assuming that there'll be a split House or a split Senate or some kind of
balance where
some kind of balance. So I think it's going to be difficult for her to get anything dramatic passed. And I think that's probably a good thing for the economy. Some of her proposals could be, deficit expanding, negative in the long run. Same thing for Trump. Neither one of them are the kind you want to put hugs around in terms of their economic policies, and they both have pluses and minuses. But I see Harris as being a little bit more neutral.
I think for sure. I think Harris is just gearing up the rhetoric right now because it's all about getting votes. You have to get votes to win. So she's going to talk about price controls. She's going to talk about gouge pricing. She'll talk about rent control. But if she's elected president, there's too many checks and balances. There's too many economic research, and Norm has probably written a ton on this, on rent control and price controls and why it's bad. So that collective understanding is already out there. I think it's just rhetoric to get people to vote for her, and she'll probably go straight to the middle, and a lot of these things won't play out, just like Norm was saying.
I hope you're right.
Isn't that the brilliance of our political system, the checks and balances, so that the rhetoric doesn't get matched in action? Isn't that what we want? That's stability, is it not?
That brings up another point. We want the Fed to stay independent. We want checks and balances. And let's hope that remains that way.
So with respect, you talk about rhetoric, but there's been, particularly in the Harris camp, early proposals about aiding and abetting the housing market. And this is something I've been thinking about. To what extent does can the federal government really impact what is nationally and certainly regionally and locally a housing shortage and a pricing crisis in the housing sector.
I don't think the federal government can do anything, quite honestly. I think what I've heard with down payment assistance and things like that, it's just another government handout. It's just another, inflation check that are being sent to people. If you're giving more financial incentives and support to people to buy homes, all you're doing is creating more demand. What we need to be talking about is increasing the supply. Increasing the supply is not at the federal level. It's got to be at the state level and led by the state, and then trickled down to the local level. So those two agencies need to be talking to each other. Other than that, it's all about, again, just getting votes saying we'll provide some tax incentive for developers if they do affordable housing. We already have a lot of that stuff. So I haven't heard anything, especially on Kamala Harris's side, that would be a game changer in terms of increasing the supply. If anything, I think is just trying to get votes, and it's going to increase demand, which we don't need right now. We got enough demand. We need the actual homes and the supply.
You must have been reading my mind, Nathan. In this week's San Diego Tribune Econometer, I answered the 75-word version almost exactly as you articulated it. It's not really.
We're going to match up as well.
That's amazing, because I have to tell you, I haven't opened a newspaper in about a week. I haven't even looked at the news because I've been out of town and everything, and I just turned it off. So
Well,
it's funny that we had the same side.
The Padres are in second place.
Well, that's news.
There you go.
Well, I think what Nathan's pointing out is the NIMBYs and regulatory agencies are not something that the federal government can do a whole lot about. So it is very difficult to impact local supply. We're seeing it in our own state, an attempt from the governor down to the local level. So Newsom's trying that approach. In terms of the grants and down payments and credits, I have a problem with anything that distorts the housing market that much and provides lucky benefits for a subset of the market. And as Nate said, it does increase demand. It doesn't do anything about broad affordability problems.
It's interesting because you'd have to bring in the whole immigration issue into this discussion. Even if it did have an impact, we have a bunch of construction jobs that have remained unfilled. We couldn't build the housing in the first place if we had all the incentives in the world right now, because we don't have the workers.
I did a little bit of analysis on that, and the maximum we could build would be about 500,000 extra units, more than we're building right now, if everybody in the industry in the past 5 years jumped back into the industry. So a million a year, no. 3 million over a term, no. Maybe 1.5 million, and that would be optimistic.
This discussion is not very much fun because we're all agreeing with each other. Are there any hot button issues that I haven't brought up with respect to the overall economy?
Well, the work from home trend has started to permeate the market so much so that the housing market's demand for second and third tier cities has just been amazing. How the large, expensive cities have lost to the benefit of the second and third tier cities that are less expensive. That's been a big shift just in the last couple of years.
And you see that as permanent?
I see that as permanent, even though the return to office movement varies from firm to firm, and some are, 100% return to office, most are hybrid. The ones that are too stubborn on this are probably going to lose talent. And I see it as a permanent leveling of the land values across the country, for lack of a better term.
So you're talking about smaller communities, suburbs, places that provide at least a perceived higher quality of life to raise families in, that are less expensive, and people aren't tethered to their office, so they can do what I'm doing and what you're doing, work at home.
And if you look at just California, all the cities that have average single family prices under $1 million have all gained population in the last couple of years, while those that are above 1.5 million have lost population, especially LA.
Yeah. I think that when we're going to the subject of real estate recession, which I want to drill down on just for a moment, this has been a very dicey couple of years, particularly in the housing market and in the commercial office sector. The industrial market seems to remain pretty strong, particularly the warehousing and the technology part of the industrial market. And the retail market seems to be sort of adjusting to its new reality. Nate and I have made a living sort of reimagining shopping centers, but the shopping centers haven't gone away. They've just compressed in size and they've become mixed use projects with housing as part of them as the other sort of dominant factor in many of these footprints. But the office market probably is specifically in the CBDs is probably at the point of no return. We're going to have to sort of reconceptualize what has to go on inside those buildings if the buildings even stay up. And that sort of goes hand in hand with the comment that you made about the sort of the suburbanization or the spreading out of America because people are not tethered to their office anymore. And I see that as not a cyclical thing, but as a permanent thing, which is going to require, from a land use perspective and from a redevelopment perspective, a lot of new kinds of thinking, maybe old kinds of thinking coming back, like in California. We eliminated redevelopment agencies. I mean, clearly we need to see tax increment financing and other kind of redevelopment catalysts to deal with what is going to be huge vacancies that are permanent in the commercial office sector, particularly in the older Class A and B inventories.
According to Gensler, 70% of the office buildings cannot feasibly physically be converted, no matter what their price is.
Yeah.
They're better off being torn down. That's a huge amount of obsolete inventory that we're going to see.
So that's the commercial office market. And obviously in the housing market, there's this giant affordability gap. There's a lack of inventory of new housing, a lack of transactions because principally people are sitting in place because of interest rates. And I think that what we're going to see with interest rates coming down is sort of a resurgence of activity, but it's not going to cure the housing problem.
Housing is going to remain tight for a while, but 2025 will be a better year for volume with those lower mortgage rates. And multifamily might start getting out of trouble as well if the rates come down enough.
Well, vacancies have gone up in the rental sector across the board, but they're not in dangerous levels. They're pretty much in pro forma decent territory, just not as decent as, we've come to expect. Instead of seeing 97, 98, 99% occupancies, maybe we're seeing 94% occupancies. But, typically when we pro forma out these projects, I think anything over 90, maybe even less than that, it has been typically okay from an investment perspective. The question is, are we going to see a change in multifamily inventory added to be condominiums versus apartments? Are we on the cusp of that of change in that regard?
Well, I'm not sure why we didn't see it the last time, about 2.5 years ago when rates went down. I thought there'd be more condo conversions. You two might be better experts on why that didn't happen.
I'll let Nate answer this more directly, but essentially the value of the units as apartments was higher than they were as condos. So people kept building apartments and the underwriting supported it.
Okay.
Yeah, cap rates were so low that the for sale values, they were almost on par, or if condos were more valuable, it wasn't substantial enough to entice people to convert. Going back to what Gary said, the fundamentals are fine right now in multifamily. I mean, 90% occupancy and above, and if you're in the 80s, you're going to get to 90. The problem we're having is a pricing problem, and it's a pricing of debt. So interest rates are high, and then as a result, cap rates are high. And that's what's stalling the entire market. That's why everybody's waiting for the Fed to act so that rates could come down and cap rates can come down just a little bit to get some money moving in the multifamily sector. I think I agree with Norm. I think 2025, we're going to start seeing people actually move on newly construction projects because, the money is finally pricing right.
I was chatting with Matt Bosa a couple of weeks ago, who is building his first condo project in the East Village market, near B Street, which is a market that really hasn't been a condominium market. He thinks this is a guy who's developed most of the downtown residential inventory, tons of condos, tipped his toe in the apartment waters, did pretty well there, but is going back to condos now. I guess I'm wondering whether we're going to see an industry-wide trend in that direction, or is the other factor, of course, is a liability insurance, reluctance on the part of developers and their architects and their contractors to even get involved in the condominium market because of the 10-year liability clause. Is that still going to be a holdback factor there?
Yeah. The challenge with condos, the last 20 years has been liability, like you said. And lenders prefer to lend on apartments because it's easier and they understand it, and you need to rent it up and you'll get there. With condos, and if you're building a single structure, you have to sell out the entire building. And if you're talking about a 200 unit complex that has to be built all at once, you can't sell all the units that fast. And so banks don't have a good feeling, and they don't want to take that risk of, being on the hook for units that may not sell. Plus, as a developer, there's a requirement of pre-selling your units. So you have to pre-sell them before you can even start construction. But you brought up a good point, Gary. Will we see like another resurgence of condos like Nat Bosa did in the 90s? Nat Bosa was the first one in and started building condos. If he's successful this time around and in this resurgence and it sells like hotcakes, then I think the market could point to an example. I feel good about this. The market is there.
Yeah.
But if sales are slow and they're not really happening, and he maybe converts it back to apartments, then that's kind of proof in the pudding. But I think, and that's the way capital works: is you have to build it all with your own money first,
which he will do.
And the markets watch you, and if you're successful, then the market develops.
Yeah, and very few developers are capable of what a guy like him is capable of. So if he's willing to take the risk, he can take the risk and see what happens. The other part of this is, and I've been saying this for some time, at least the last year, we've reached peak rental levels. I mean, as far as apartment market going forward, if the other factors of production, namely labor, we've talked about capital coming down, but materials, if these factors continue to be high and perhaps continue to increase, we're not going to see a concomitant increase in rent levels because the market's tapped out. I mean, consumers just aren't going to pay more right now.
You're saying just affordability. Sure.
Yeah. And so that will tamp down demand for apartments, and that might be a factor in terms of shifting to condos for that sector. And we need people to buy.
I'm wondering if technology is also helping multifamily apartments more than it helps condos. That is, I might be able to bring down my operating costs, my management costs, my investor reporting costs, my rent setting practices with more use of prop technology, good apps, and I can do that in multifamily. And for condos, I'm not sure that we get that many advantages out of the technology. And so we might be seeing this evolution of multifamily becoming more efficient in terms of how we operate it going forward, which would help the values stay a little higher than otherwise.
Would that portend are you suggesting sort of a permanent shift to a more rental dominated housing market versus people buying? And going back to the big picture, can the federal government, is that a desired goal? Is that a way for the federal government to impact the market?
It's the opposite of the stated goal of home ownership, but given our current tax laws, where the standard deduction is now much higher than it used to be, and it's stayed that way, more than half the U.S. households cannot itemize, at least not logically. It's not rational for them to itemize, and that's even if they buy a home, because they'll be buying in a home price area that's too low to have the benefits of itemization. So I think that the tax laws have tilted us towards rental. And I think that the quality of the rental choices has improved dramatically, especially with the build to rent and the condo rentals and, the single family rentals that are facilitated by better technology. So I think there's more choices out there, and I do think the homeownership rate will come down a little bit unless interest rates come down a whole lot. Then it would swing the other direction again.
So overall, in terms of economic prospects for the coming year, post-election, regardless of who's elected, you guys are seeing a better real estate market than what we've experienced the last couple of years. Is that what I'm hearing?
Well, there's got to be a lot of pent-up demand and pent-up turnover from people sitting on low mortgages that are just going to stay there until the rates come down. So when that is released, just imagine when that turnover is released, just people moving, that's going to help Home Depot and lumber companies, and remodeling companies, and moving companies, and appraisers, and title, and mortgage lenders, and brokers and agents.
Don't forget consultants.
And consultants. Yeah. So I see that as a big plus when the interest rates come down enough. And that could continue to happen slowly over the next year.
So that was really where I was going. We're talking about this next Fed meeting that will result in either likely a 25 or 50 basis point reduction. But what about after? What about the next month and the month after that? What do you guys expect to happen there?
More declines.
So a continuation of a downward trend to reverse
Yes.
the upward trends that we've seen.
Yeah, once they start and they announce that they're going to continue, quarter point, quarter point, quarter point. And as Nate said, they really have to kind of execute on what they say or even hint about, because the market likes that forward expectation to
So that'll
be.
sort of get baked in, and we'll have to see those rate reductions.
Yeah, whether it's 3 drops or 7 drops, I have no idea, but I would expect more drops than anything else.
So the initial exuberance of the first drop would be followed by subsequent drops, which would be, once they bleed into the economy, you know, that portends sort of long-term economic upside, prosperity, stability, all those things, right?
They have a long way to
Yeah.
go in terms of the lowering the rates. So we could have several drops, yes, over the next year.
Yeah, I think 2025 will be a year of more activity, especially in the transactional and the refinance market. I said even last year's forecast, I saw discount rates coming down to 3.25 to 3.5 and stabilizing there once we get back to where we need to be. And if the spreads compress down to that 180 basis point range, we're looking at 5.5% interest rates. So that's kind of what I still see in my head. Maybe we don't get there until the end of 2025 or early 26, but I think we'll see that slow march down and we'll see more activity. The one thing, though, that gives me concern into the future is future development, especially as it relates to housing. And here's why. The last economic cycle we had since 2010 has been great for governments. They can put out any regulation and development will figure out how to pay for it because rates were really low, cap rates were really low, which means high values, and rents were just skyrocketing. This time, when we recover in the next couple of years, it will be in a higher interest rate environment. It'll be in a higher cap rate environment. So I think the governmental Goldilocks era of requiring whatever affordable housing policies or other fees and things like that, they're going to hit up against something in the development industry, especially in the state of California, because we're not having the same rental rate increases that can afford all those goodies. So I think we're going to have a reconciliation and it'll be very difficult and it won't be immediate. It's going to take years for governments to understand what's going on with the market forces. But that's something to watch is I don't see it opening a floodgate of development because I think we're going to run up against policies that need to be augmented and adjusted to allow for new market realities.
What do you guys think about the new projects that we see proposed in San Diego? Every one of them is mega. I mean, whether it's Navwar or Sports Arena or Seaport Village or name your mega project. So many units. I know it takes a long time to build them.
Yeah.
If they really do come online, won't San Diego's housing market, at least surrounding those areas, soften for a while?
First of all, you're right. Anything that, even if we're talking about multiple thousands of units per project, Navor, I think, would theoretically add 8 to 10,000 units. I think the sports arena project, we're talking 3 or 4,000 units. These would be phased out over 10-year plus periods. So the market would not get flooded, and presumably it wouldn't be built unless the demand was there. We're seeing this, for instance, in I forget the name of the project in Mission Valley on the golf course that Gerald Hines is doing. But they said, well, we're just going to delay our start. We're going forward, but that's effectively phasing. So the market, they're going to make sure the market catches up to it. And then the implicit question you're asking is San Diego an urban enough community to accommodate big vertical high-rise projects? Is that demand still there? And will these units built find a market? And I suppose that sort of leads to the question, are we transitioning as a community from sort of suburban villages to urban mixed use, high density, vertical environment, big city? And the answer has to be yes. The real question is, how long will it take? And, will there be fits and starts in between? But the way I see San Diego is that it needs the housing of any kind. It is transitioning as a city, and there's people that are going to continue to resist that. So it may take a little bit longer, but these projects are real. They will be built. They'll just be phased according to the ability of the market to accept them. Thank you, Norm. Thanks, Nathan, for this update. We'll do this occasionally. Again, I think we'll do this again for sure after the election to see, how the markets are playing out towards the end of the year, and see if anything that we've said is actually correct. Thanks again. I will talk to you very soon.